You've worked hard your whole life. Now let's make sure your money works just as hard for you in retirement. And so how exactly do you do that? I'm going to show you some things that'll help you hold on to your money throughout retirement in today's uncertain markets. I'm Judith Nagley, and I'm a financial advisor. I've built businesses, sold businesses, I've grown wealth, and I've helped thousands of people, and now I'm here for you. First off, understand that there are risks to investing, and nothing is guaranteed unless you buy a guarantee, like an annuity or a pension, and watch my video on annuities to learn a little bit more of what those are all about. So let's take a look at what I'm going to cover in this video. Market summary, strategies to help protect your lifestyle from rising costs, common investing pitfalls in retirement. Let's get started by taking a look at the Standard & Poor's 500 Index, S&P. So at first glance, some investors would say the S&P 500 appears to have gradually climbed over time, and we would agree with that assessment. However, it can be easy to miss the periods of market volatility characterized by declining stock prices. For example, consider the volatility that resulted from the onset of the 2020 COVID pandemic. Though recovery was swift and the market found new highs later that same year, investors won't soon forget the sudden sharp decline in stock market prices. Right? The stock market is not the only thing we're going to talk about today. The health of the economy as a whole also needs to be considered. And let's take a look at the gross domestic product, or the GDP. This chart shows the trend in GDP growth from January 2022 to the first quarter of 2024. I've got a more updated chart without the percentages on the next slide that includes, that quarter one of 2025. So let's look. Early 2022, the economy briefly contracted in quarter one before rebounding strongly in Q3 and Q4. And in 2023, there showed really robust growth, peaking at a 4.4% growth in Q3. And in 2024, growth slowed, stabilizing around 2 to 3% each quarter. In 2025, Q1 saw mild contraction, and it was influenced by increased imports and reduced government spending. So you can see that GDP growth, has varied from quarter to quarter over the past couple of years. So what will the GDP show for the rest of 2025? And it's uncertain, right? Of course, but that doesn't mean we can't try to predict and estimate the GDP. And that's something market strategists and economists look at, and we study them all. But what I can tell you is that the Bureau of Economic Analysis, the BEA, they released two estimates and one final figure for each quarter's GDP. And the GDP that they produce is something that we take a look at, of course, as well for knowing where the economy is. Now, the BEA considers many economic reports when calculating GDP, and those reports simply change over time. So what are the key drivers of the Q1 2025 dip in GDP? Surge in imports, about, 41% surge in imports. Anticipated tariff hikes, both businesses and consumers rushed to stockpile foreign goods, which inflated imports. Since imports are subtracted from GDP, this surge cut over 4% points from growth. And there was a decline in federal spending, a 4 to 5% drop in government expenditures, and its largest quarterly fall in years also contributed to the slowdown. There has been sluggish consumer spending, and growth in consumer spending slowed dramatically, jumping just 0.5% compared to 4% in late 2024 due to caution over tariffs, wage pressures, and weak confidence. So what I'm trying to show you is this. See how overall world economy and economics has a major effect on our market. That's a brief look at where we are now with the stock market and the economy. Let's move forward and discuss some of the key challenges we face when building a wealth management strategy. First, we'll talk about inflation. I like to teach my clients about inflation by telling them that it's possible their last car may have cost more than their first house. Inflation is the rate at which the average price level of a product or service in an economy increases over time. Let's take a look at how inflation has impacted the prices of critical items over the past 30 plus years. Many hope to experience an improved quality of life during retirement, and the proposed agenda for many retirees includes traveling, indulging in hobbies, enjoying time with family. However, some may forego a factor in rising prices. So the U.S. Bureau of Labor Statistics reported in May of 2024 that inflation was 3.5% for the prior 12 months. And with many Americans living 25 or 30 years in retirement, it's just critical to factor inflation into your financial strategies. Now let's take a look at the slide. In 1993, the average cost of a house was $125,000, and in 2024, it was $420,000. A loaf of bread cost 75 cents back in 1993, and it is now well over $2. About a loaf of Sara Lee white bread, the kind that my kids really like, yesterday for $2.68. So let's take a look at this chart. At 2% inflation, if you're currently living on $50,000 per year, in 10 years, you will need $61,000. In 20 years, you will need $74,000. In 35 years, you'll need $100,000. And that's what inflation does. If you live 25, 30, or 35 years in retirement and we see inflation do what it's done here, will your portfolio keep up with inflation? Will your withdrawals keep up with inflation? Here's the good news. Americans are living longer. Here's some potentially bad news. We're living longer, and that creates a challenge for a retirement portfolio. This slide shows the probability of survival beyond age 65 for a couple. If you're a retired couple, both age 65, the likelihood that one of you will live 20 years in retirement is 85%, and there's a 64% chance that one of you could live to be 90 and spent 25 years in retirement. So if you only prepare for, say, 10, 15, or 20 years, there's a good chance you could come up short. For this reason, it is especially important to use investment strategies that try to balance a sustainable withdrawal rate with the appropriate measure of risk. Balancing these factors is critical, right, to help you create a strategy that's designed to ensure you do not run out of money before you run out of life. Longevity can drastically affect how you take money out of your retirement savings. And to show how important this is, if you withdraw just 1% more than your proposed withdrawal rate, you may not have enough money to continue this strategy before you die. This is a mathematical truth. This is why accuracy is so critical, because the razor-thin margin between 1% too much and getting it right could have a significant effect. When I sit down with people, I typically ask them, what withdrawal rate do you feel is sustainable? And I usually get a variety of answers. On average, I hear rates of 5% or 6%, and they may be right if they say 5% or only live to age 95, and as demonstrated above. However, even looking at a portfolio that is 50% stocks, 40% bonds, and 10%, let's say, treasury bills, like the one shown here, notice the impact of increasing withdrawal rate by 1% up to 6%, and another 1% up to 7%, and so on. Can you imagine what happens if this portfolio were entirely in cash or fixed income? This shows that if someone is too conservative, their likelihood of running out of money is significantly greater because their portfolio can't keep up with their withdrawal rates. This is especially true when you add in the impact of inflation and longevity. This is one of the key things we try to help our clients figure out, and that's why we recommend working with a qualified professional. Experience has taught us that there are 4 basic ways to address risk. You might illustrate it this way. If you choose to drive a car, you have 4 choices related to managing the risk associated with that activity. Ignore: if I crash, I'll just buy a new car. Avoid: I won't drive at all. Manage: I'll drive defensively with my hands at 10 and 2. Despite your best efforts, doing this doesn't mean you won't get T-boned. Number 4, transfer: I'll buy car insurance. And when it comes to investing, decisions on whether to ignore, avoid, manage, or transfer risk will vary from person to person. Our job is to educate you about your options and help you make the right decision. It's also critical for investors to consider their personal risk tolerance. Now, so this is why whenever we build portfolios for our clients, we always conduct an in-depth risk assessment with them. Low investment risk. You have trouble dealing with any downturn and want consistent returns, even if they're low. Medium, large performance swings may keep you up at night, but a moderate amount of fluctuation is okay with you. And high risk tolerance, even large performance swings won't derail your investment strategy. You're as steady as a rock, is what one would say right there. Selecting a suitable combination of investments to meet your objectives is extremely important. Multiple studies have shown that asset allocation is the primary factor that influences volatility and return in a portfolio. A landmark study showed that 88% of portfolio performance over time could be attributed to the mixture of assets in the portfolio. So the bottom line is, it's not picking winners or jumping in and out of the market that determines long-term investment outcomes. It's picking the right mix of investments for your personal situation. Although we believe it is prudent to have a core passive investment selection that are allocated for long-term growth potential, we also know that just because something is a good investment today doesn't mean it will be a good investment tomorrow. This is why we choose to engage in the human element in the form of a single manager, co-managers, or a team of managers, right? When making investment decisions, and active managers rely on analytical research, forecasts, and their own judgment and experience in deciding what securities to buy, hold, and sell. And although active management cannot eliminate the risk of fluctuating prices and uncertain returns, ensure profits or guarantee against losses, both at our firm and at most of the investment companies where we place our clients' assets, an active management strategy is frequently employed. Now, let me go into that. The active management is when an investment manager attempts to outperform the market by predicting market activity, and they can add value to portfolios by anticipating market cycles and continuously changing asset allocation over time. So ultimately, total wealth management doesn't leave out any pieces, right? As we go about managing the wealth of our clients, we employ many strategies. Additionally, we're not advocating any of these strategies to anyone, not on this video. The strategies we use for you personally may be very different from the strategies we use for the person sitting next to you, based on a number of important factors. So please remember that we're sharing, I'm sharing this with you strictly for informational purposes. Investing, again, involves the risks, right? Which includes the potential of loss of principal, and no investment strategy can guarantee profits or protect against loss, right? In periods of declining value. Now, everyone's investment needs are unique, and we work hard to structure a custom portfolio for each client. And I would recommend visiting with a professional, whether it's me, whether it's someone else, to go through that experience. And so to illustrate how we do this, let's imagine a portfolio that has 5 buckets. This is always a good one. Bucket number 1 contains the money we put away for the income needs of your family for the next 12 months. Bucket number 2 contains the income that you'll need for years 2 and 3. Bucket number 3 contains the income that you are going to need for years 4, 5, and 6. Bucket 4 contains the income that you will need for 7 to 10. Bucket 5 contains the money that you will need for year 11 and beyond. Now, do you think we should be managing the money that you will need for the next 12 months in the exact same way as the money you will need 11 or more years from now? Absolutely not. So as previously stated, the first bucket contains the money that we put away for the first 12 months. In the second, the money you need for years 2 to 3, or in the third, for years 4, 5, and 6, you can start becoming a little bit less conservative. And how about the money you will need from year 7 to 10? Do you think you could start to take a little bit more risk with that. And where's the risky part of the portfolio? Well, the aggressive part. Naturally, that would go in bucket 5, the money that you won't need for another 11 years or more. So basically what we're doing is assessing your short, medium, and long-term needs, as well as spreading the money into different instruments with the proper amount of risk and liquidity. And in this way, we strive to ensure that you are prepared for various future phases of life. Both the challenges and the strategies we've discussed here on this video can be very difficult to balance properly. And as we have highlighted, just one misstep can make the difference between enjoying a prosperous retirement and winding up broke. So please let us help you. Let a professional, financial professional help you protect what you have worked so hard to earn. In summary, what are we going to help our clients work through is all these different factors that we've already talked about. We help you diversify across asset classes and set realistic expectations for performance, communicate with you regularly, and educate you about factors that could affect your financial future, encourage you to think long-term, tune out the noise, and avoid knee-jerk reactions, monitor your portfolio, and recommend changes over time. We'd be more than happy to provide you with an obligation-free complimentary assessment of your portfolio. Even if you're content with who you're working with or with your holdings, it may be wise to get a second opinion. So much like you would visit a doctor for a second opinion before making an important medical decision, your financial health deserves special attention as well. So if you or someone you know from, can benefit from a conversation with us, have them contact us. It's easy. You can just go to our website. I'll drop my scheduling link directly here in the comments box as well. And I'm a big fan of speaking on the phone. So I'll leave my phone number here as well. And I'm happy to take calls from people. So thank you.